While Donald Trump was imposing 35% tariffs on Canadian goods and openly threatening to make Canada the 51st state, something unexpected was happening on the West Coast that nobody in Washington saw coming. Throughout 2025, Canadian oil tankers quietly began loading at the Westridge Marine Terminal in British Columbia, heading across the Pacific to ports in China, Singapore, and Hong Kong. By October 2025, Canadian exports to non-U.S. destinations hit an all-time record high. And here's the number that should terrify American policymakers. Of the $18.5 billion in Canadian exports lost to Trump's tariffs, Canadian businesses have already recovered $11 billion by pivoting to 27 different trading partners. China just became Canada's second largest customer. And the infrastructure that made this possible was completed while Trump was still tweeting threats. This isn't about trade negotiations or diplomatic warnings. This is about the largest economic reorientation in Canadian history happening in real time, and the consequences are reshaping North American power dynamics in ways that can't be reversed. Here's what makes this moment unprecedented. For generations, Canada has been economically captive to the United States. Roughly 70% of all Canadian exports flow south across the border. Canadian manufacturers, energy producers, and agricultural exporters built their entire business models on one assumption: that the American market would always be accessible. That assumption just died. According to internal economic projections obtained by multiple Canadian outlets, if the current tariff structure remains in place through the 2026 CUSMA review, Canada faces what Oxford Economics is calling longer-term scarring. The size of the Canadian economy would be lower for several years, probably permanently. Those aren't speculative warnings. That's the baseline forecast from one of the world's most respected economic research firms. So Canada made a choice. Instead of waiting for Trump to change his mind or hoping for trade negotiations that might never materialize, Canadian officials and business leaders launched the most aggressive trade diversification campaign in the country's modern history. And the centerpiece of that strategy is a pipeline expansion that Trump's own administration tried to kill multiple times but couldn't stop. The Trans Mountain Expansion Project, completed in May 2024, increased Canada's oil export capacity from 300,000 barrels per day to 890,000 barrels per day. And almost all of that new capacity is flowing west to Asia, not south to the United States. Let's talk about the numbers because they tell a story that most Americans don't know and that Trump's administration doesn't want to acknowledge. In 2024, before the Trans Mountain Expansion was completed, Canadian oil exports to Asia were essentially zero. By October 2025, according to data from Canada's State of Trade report, Canadian oil shipments to non-U.S. destinations were averaging $660 million per month. That's nearly $8 billion annually in new export revenue that didn't exist 18 months ago. And the breakdown of where that oil is going reveals the scale of the strategic shift. 59% of Alberta crude shipped by sea in the last 7 months of 2024 ended up in China, 15% went to Singapore, 12% to Hong Kong, and only 11% stayed in the United States. Think about what that means. Canadian energy producers, who for decades had no choice but to sell exclusively to American refineries at discounted prices, now have leverage they've never had before. When Trump threatens Canada with higher tariffs or suggests annexation, Canadian officials can point to Asia and say we have other customers. But it's not just oil. According to analysis from the Globe and Mail, Canadian businesses across multiple sectors have been rotating their export markets faster than economists predicted. The report specifically notes that Canadian firms tapping into 27 trading partners have recovered nearly $11 billion of the $18.5 billion lost to the United States. That's not theoretical diversification. That's actual revenue replacement happening in real time. And the infrastructure investments that made this possible were years in the making. The Trans Mountain pipeline expansion cost 4.7 billion Canadian dollars and faced intense opposition from environmental groups and some Indigenous communities. The Obama administration was skeptical. The Trump administration actively tried to obstruct it. But the Canadian government pushed forward anyway, and now that decision is paying off in ways that go far beyond energy exports. The Westridge Marine Terminal, the endpoint of the Trans Mountain pipeline, has capacity to load 630,000 barrels per day. As of available data through April 2025, throughput hasn't exceeded 450,000 barrels per day, which means there's still significant room for expansion. Canadian officials are now working with the Port of Vancouver to address operational bottlenecks that limit traffic through narrow shipping channels, specifically to increase capacity for Asia-bound exports. Now, here's where this stops being a trade story and becomes a fundamental crisis for American economic strategy. For over 70 years, the United States has operated under one critical assumption about North American economics: that Canada and Mexico are effectively captive markets. Geography, infrastructure, and decades of integrated supply chains meant that Canadian exporters had no realistic alternative to American buyers. That dependence translated into enormous leverage for Washington. When American presidents wanted concessions on trade, labor standards, environmental policy, or border security, they could threaten economic consequences knowing that Canada had nowhere else to go. That leverage just evaporated, and the implications go far beyond oil exports. According to leaked economic assessments cited by multiple Canadian economists, Trump's tariff campaign was supposed to force Canada into submission. The theory was simple: hit Canadian exports hard enough, cause enough economic pain, and Canadian officials would accept whatever terms Washington demanded. But something unexpected happened. Instead of capitulating, Canada spent 2025 building alternative trade relationships at a speed that caught American strategists off guard. Prime Minister Mark Carney personally traveled to the Middle East, Europe, and Asia throughout the year, signing preliminary trade frameworks and investment agreements. The Canadian government launched what it's calling the Trade Diversification Strategy, specifically targeting Asian markets where demand for Canadian resources, manufactured goods, and agricultural products is growing faster than in the United States. And here's the part that should concern American policymakers the most. This isn't temporary adaptation. This is permanent infrastructure. Once Canadian energy producers establish long-term contracts with Chinese refineries, once Canadian manufacturers build supply chain relationships with Asian buyers, once shipping routes and logistical networks are optimized for Pacific trade instead of cross-border trade, those relationships don't just disappear if Trump leaves office or changes his mind about tariffs. The International Monetary Fund's latest projections show Canada is expected to have the second fastest GDP growth in the G7 in 2026, behind only the United States. That growth is happening despite Trump's tariffs, not because they were lifted. Canadian officials are openly stating what American policymakers don't want to hear. The United States is no longer a reliable partner. Those aren't words you can take back. That's a fundamental reassessment of the relationship that has defined North American economics since World War II. So let's talk about what this actually means for American economic power, because the consequences extend far beyond Canadian oil shipments to China. For decades, the United States has been able to conduct trade policy with its neighbors under one massive structural advantage: geographic captivity. Canada and Mexico couldn't easily redirect their exports elsewhere because the infrastructure didn't exist, the distances were too great, and the transaction costs were prohibitive. That meant Washington could impose conditions, demand concessions, and threaten economic pressure, knowing that Canadian and Mexican exporters would eventually accept American terms because they had no alternatives. That advantage is disappearing in real time. And it's not just Canada. According to trade data compiled by economists across multiple institutions, Mexico has also been accelerating trade diversification efforts, particularly with Asian markets and the European Union. The pattern is clear. America's closest neighbors are systematically reducing their economic dependence on the United States because Trump's tariff policies demonstrated that trade relationships with Washington come with unpredictable political risk. Here's where the numbers get alarming for American interests. Canadian businesses have recovered $11 billion of the $18.5 billion in exports lost to U.S. tariffs. That's a 60% recovery rate in less than 18 months, and that recovery is accelerating. The Globe and Mail reports that Canadian firms are rotating export markets faster than analysts expected, which suggests the learning curve for accessing Asian buyers is shorter than economic models predicted. If that 60% recovery rate holds or improves, Canada could fully replace its lost American export revenue by late 2026 or early 2027. At that point, Trump's tariffs stop being leverage and start being irrelevant. Canadian exporters won't need American market access badly enough to accept unfavorable terms, which fundamentally rebalances the negotiating dynamics heading into the CUSMA review scheduled for July 2026. But there's a deeper strategic problem that goes beyond trade statistics. The United States has spent billions of dollars and decades of diplomatic effort building what it calls continental energy security. The concept was straightforward: integrate North American energy markets so tightly that Canada, the United States, and Mexico function as a single energy bloc capable of withstanding disruptions from hostile foreign suppliers. That required massive infrastructure investments, pipelines connecting Canadian oil fields to American refineries, cross-border electricity grids, shared natural gas networks, coordinated regulatory frameworks, and the implicit assumption behind all of it was that Canada would always prioritize the American market because it had nowhere else to go. The Trans Mountain expansion just broke that assumption. Canadian energy now flows west to Asia as easily as it flows south to the United States. And once that infrastructure is fully operational and optimized, the idea of continental energy security becomes obsolete. Canada isn't captive anymore. So where does this go from here? The immediate test comes in July 2026, when Canada, the United States, and Mexico are scheduled to conduct the mandatory review of the CUSMA trade agreement. According to statements from Prime Minister Mark Carney, Canada is accelerating efforts to deepen trade relationships in preparation for those negotiations. Canada's Trade Minister Dominic LeBlanc is scheduled to meet with his American counterparts in mid-January to begin preliminary discussions. But Carney has already signaled that Canada's approach has fundamentally changed. In December, he stated publicly that Canada is unlikely to reach sectoral agreements with the United States before the broader CUSMA negotiations begin, which means steel, aluminum, lumber, and automotive tariffs will all be on the table simultaneously when talks officially start in July. That's a significant shift in strategy. Instead of trying to negotiate relief on individual sectors where Canada is most vulnerable, Canadian officials are preparing to use the CUSMA review itself as leverage, potentially threatening to walk away from the entire agreement if American tariffs remain in place. And Canada now has credibility to make that threat because the economic data shows they're surviving without full American market access. Despite Trump's tariffs, despite the loss of $18.5 billion in export revenue, despite the uncertainty and disruption, Canada's economy is growing. The IMF projects Canada will have the second fastest GDP growth in the G7 in 2026. Canadian unemployment, while elevated compared to pre-tariff levels, hasn't collapsed. Manufacturing employment is down 30,000 jobs since March 2025, but that's actually better than the United States, where manufacturing employment has fallen by 60,000 jobs over the same period due to higher input costs and supply chain disruptions caused by Trump's own tariff policies. So Canada enters the CUSMA negotiations with leverage it's never had before, the demonstrated ability to survive and even grow without complete dependence on American markets. But here's what should worry everyone watching this situation. Trade diversification isn't reversible. Once Canadian oil producers sign long-term contracts with Chinese refineries, once shipping routes and logistics networks are optimized for Asian markets, once business relationships are established and supply chains are reconfigured, those changes become permanent features of the economic landscape. Even if Trump reverses course on tariffs, even if a future American president tries to restore the pre-2025 trade relationship, Canadian exporters now have options they didn't have before. They have customers in China, Singapore, India, and across Asia who are willing to pay market rates without the political volatility that comes with selling to the United States. And that fundamentally rebalances North American economic power in ways that can't be undone. The era of Canadian economic dependence on the United States is ending. And it's ending because Trump's tariffs forced Canada to build the infrastructure and relationships necessary to escape.